So what about the ways that backtest can lie? I mean, a quick Google search will bring up lots of articles about problems with backtesting. We've already talked about outfitting, but what about other things like market impact and transaction costs?
Right, so I mean the aim is just to have a backtest which is good enough. We can never simulate reality perfectly. So some things like transaction costs you mentioned, we actually do know precisely, but other things such as the market impact we may have or the bid-ask spread we need to pay when we trade, we can only make some sort of estimate. So what we do is we model these things and we just want to make sure they're close enough, or that we need to balance, I guess, between what's practical and what's important.
Yeah, and one other thing we do is we actually run our backtest system feeding it live data. So we give it live data, it can then make simulated trades in real time, crossing simulated spreads, and we simulate things like market impact and slippage, and then we compare that with our live system, which is also running alongside it. And if those things are matching it, then essentially we know that our cost models are correct, and if they don't, we have to go back and look at adjusting them.
So they might not always be exactly the same?
Correct. In fact, they're never going to be exactly the same because we know we can't simulate reality exactly. As an example, showing on this slide is a live example from our monitoring. We can see what profit the backtest thought it should be making, and we compare that to what we were actually making in real time.
They look pretty close.
Yeah, and that's what you want.
Yeah, and it gives us real confidence that the system is working the way it's supposed to be. And from this, you can see the assumptions that we have made about things like slippage, market impact, and other things are correct. And as I said before, if they're not, we adjust them. But another really important thing is that the backtest system, which is running live, is also giving us confidence that the live system is also running correctly.
Hang on, so you're checking that the backtesting system is correct, but also that your live system is correct?
Yeah, that's right, and that's really important. One of the biggest risks of algorithmic trading is that there's an error in the computer code. A mistake has been made somewhere, and that's going to lead to unexpected bad trades that cost us money. And we take this risk extremely seriously. We go to great lengths to make sure we have checks and double checks that this can't happen. But perhaps, go ahead.
No, I was going to say, well, this is where our background in ultra high frequency trading comes very helpful.
That's right, because those systems do thousands of trades in a second, so they can lose lots of money really quickly.
Yeah, and I guess the Argonaut system trades far less frequently, but we still apply all the rigorous testing and frameworks of development to ensure that the code is correct and the code executes correctly, and we don't get these kind of errors.
Yeah, and I guess probably the most important check, which we've talking about, is just watching that live system versus backtest with these two independent systems checking each other. If both of those systems are telling us the same thing, we can be pretty sure we're safely on the right path.